everybody, and welcome to the Hump Day Market Update. I'm Lee Seiler, also known as the Stock Doctor. Alongside of me is our megalennial, Miss Nikki Ward.
Deji and I were just talking about nicknames and that you can't assign yourself one.
No, you can't.
Do I have one?
No, you can't.
I was walking him through the fundamentals of nicknaming.
Jared in our office tried to make his own. You can't do that.
Classic Jared.
Yes. Your name, I think my wife came up with your name, actually.
She did, yeah.
Yes, because you are a millennial, but you're not your typical millennial. You are an extremely sharp, certified financial planning millennial because
I want to work.
Yes, right.
I'm not entitled.
You're entitled. No, you're not entitled, actually. You're one of the few that are not entitled, which I do like that.
I don't think there's just a few of us.
There's just a few of you.
Listen, every generation gets a bad rep. Don't make me start, hating on the baby boomers right out of the gate, Lee.
No, people love the baby boomers.
Oh, yeah.
They're the ones with all the money. They're the ones with all the money.
The best.
So listen, we're going to talk about today. We're going to talk about the markets real quick. But before we do that, the plan for this episode, first of all, this will be our last episode for a few weeks because Andrew, our producer, is he's a tech genius, and he is going to
his
California.
skills are required elsewhere.
Yes, they're required elsewhere. So anyway, that being said, he is not. I'm trying to find the screen. I was doing this. He is not going to be here for a few weeks traveling. So, but we'll be back, and we'll talk about a lot of different things.
And we might try and bring you a show in between then.
We're going to try and figure out if he can show us how to do it remotely.
Yeah.
That would be fantastic. So let's first talk about what the markets did today. And we had a pretty good day after a couple of interesting ones. We had, not a great day on Friday or Monday. And, earnings were coming out. Earnings have been pretty good for the most part.
I was going to say earnings that hasn't been the issue. It's been a period of digestion. We had a weak jobs report on Friday.
Yeah.
The labor numbers were kind of turning over. We had, revisions. We had a firing of the Bureau of Labor statistics.
Yeah, because they didn't like the statistics.
Right. Yep.
Yep.
We had Jerome Powell didn't cut.
The tariff thing is still in play.
Yep.
The tariff situation is still in
that's
play.
Now, today the news as far as the Trump tariff tirade.
But after a couple of bad days, down like 500 some points on Monday, we had some nice recoveries yesterday, and then today, which by the way, today is Wednesday, August 6th. So this is when we're recording the show, and it's actually just now 7:00. Thank you. The Dow up 81 points today at 44,193. The S&P 500 up 45 at 63.45. The NASDAQ up 252 points. So the NASDAQ was the leader of the day, up 1.21% at 21,169. And the NASDAQ was led, obviously, by the Mag 7 again, really. And the Mag 7, who one stock recently was basically annexed from the Mag 7, is back today, and that's one of my favorites, one that I've owned for many, many years.
Listen, we don't want to divide the room, right? We're not here to talk politics, but you're either one or the other.
You're either Apple or
an Apple or an Android, all right?
Yeah, and you know what? Apple has not been a great performing stock this year, and that's really dragged down some of the indexes.
Yeah.
But if you look at this is Apple on December 31st. We were right around 260 a share, so in the 250 range, and before today, because today we were up $10, they were at 203. So Apple's down 20% year to date.
Yeah.
And that's a drag, on a lot of portfolios. And that being one of our our largest single stock holding, it is a drag.
It's grown to that. But
yeah, no, it's grown to that. We don't ever have the positions that grow to this degree.
Magnitude. It doesn't happen overnight. It's happened since 2011.
Yeah, we bought Apple in 2011, a big chunk at 2011. Then we bought a bunch more in 2016, and over the years we've bought some. We haven't bought any recently, but it's the stock is really acting. Today was a really good day on tremendous volume. Is 2 times average daily volume, and for a stock like Apple, that's pretty incredible. Up 5%. But it's still lagging, and it's trading below some important moving averages. This right here, this black line, is the 200-day moving average. So there's an old saying that nothing good happens below the 200-day. So
Or after midnight.
Or after midnight, yes. We've told our kids that for many years. So, Apple was a star of the day, but, a lot of the other ones did okay, too. NVIDIA was up a little bit today.
So extended.
Broadcom, and we'll talk about that, extended stock. Broadcom had a pretty good day, up nicely. Those Mag 7 stocks continue to be pretty strong. AMD.
Yeah, I was gonna say let's talk about
AMD, which is a stock we have nice profits in. I own. By the way, I just want to clarify. We have to disclose which one. I do own Apple. I do own Broadcom, and I own AMD. Not sure what you own. Okay, all right, you own those. So AMD came out with earnings. They were a little bit light on their guidance.
Light in the loafers.
The revenue was pretty good. Stock was down 6%, but it had made a really big run. If you look at AMD back in April when the market corrected, it went from 76 to about 170-ish, and today at 163. So I'm not that concerned about AMD. Volume was high. It was 153% of average daily volume. I didn't sell it. We have profits in the stock. And I do believe that this recovery is legit with AMD. So I don't think that a little bit soft on the earnings and maybe a little bit on the guidance is really going to reflect, I think, long-term on the stock. Because the whole theme today is really looking at the long-term.
Yep.
All right. And as a certified financial planner, Nikki, you talk to clients and most of your day consists of helping clients develop that plan that whatever their goals may be. And we've put that, we've talked about the three buckets, and a lot of people use those strategies. This is not unique, but there's your short-term needs, there's your intermediate-term needs, and your long-term needs. And long-term is usually retirement.
Right.
So one thing that's interesting is that a lot of people think that, short-term is really, investing for the short-term is super important. And what you want to do is that, I want to go out and I want to just trade a bunch of stocks and have some, a lot of profits. But along with that,
or that you have to outsmart the markets in order to have success as an investor.
Yeah, and the title of this program or episode is Time in the Market, not timing the market, because there's a lot of reasons why you don't want to go in and out of the markets. And most importantly is because no one is good enough to be able to do that.
Yeah, it's a fool's errand. I mean, you have to be right twice as far as when to get out and then when to get back in. And that typically leads to people who don't have financial advisors getting out at exactly the wrong time and getting back in at the worst possible time. The opposite of what you want to be doing, which is buy low, sell high, is what ends up happening when you try to time the market as someone, without a fiduciary guidance.
Yeah, and everybody reads and watches CNBC, and they read the Wall Street Journal, they read CNBC.com, all those sites.
Or they're on a Reddit Wall Street Bets thread.
Yeah, that's the worst. But and they all you listen to analysts. We listen to analysts. There are a lot of well-respected analysts on Wall Street, and we listen to them. But most of them are wrong.
Yeah, we take it all with a grain of salt.
Some are right. I mean, that's just the way it is. I'm going to give you an example of something here. This is great.
Can you put it into slideshow?
I can, thank you.
So it looks pretty.
Yes, I can do that from current slide. Thank you very much. That was a baby boomer move. So this is these are some of the top analysts on Wall Street for 2024. What they thought, they were polled in the beginning of 2024 as to what they thought the S&P 500 would be at the end of the year.
I mean, look at these firms too. I mean these are
tremendous.
No slouches, right?
Bank of America, Barclays, BMO, Cantor, Citi, Deutsche, Goldman, JP Morgan, Morgan Stanley, Oppenheimer. It goes on and on. You have a tremendous list. So if you see all these numbers, and what this is where they thought in 2024 the S&P would close. Okay.
At the end of the year.
And this is what earnings per share they thought would be. So I'm not going to worry about earnings per share right now in the S&P. Well, I don't want to talk about this. So the average of these numbers are 48.33. The median is 48.50. So let's just call it 48.50. The high was 5,200. The low 4,200. These were analysts.
Quite disparity. I mean, it's all over the board.
All over the board. Analyst expectations. So let me see what the low.
And this is what they do day in, day out. They crunch these numbers.
The low number, let me see here. JP Morgan, it looks like had the low number. All right, JP Morgan had the low number at 42 4,200.
42.
Let's see, 5,000, 5,100.
Fun
Scott
stat,
over
Tom
City.
Lee.
Tom Lee is always. By the way, he's been really, really right. By the way, he's 5,200.
Also Oppenheimer.
And Oppenheimer. Okay,
Not
so
going to try that last name.
see, I'm not gonna try it either. Stoltzfus, but Tom Lee has been absolutely right. When I say this, he started the year 5,200, but he upgraded his numbers throughout the year as he saw things progressing. So,
As one should. It should evolve over time.
so the average was 4,800, call it 4,850. The S&P 500 closed 2024 at 5,881. So that is a 20% difference. They were wrong by 20%. How would you feel to have an extra 20% in your portfolio if you listened to any of these guys, even Tom Lee?
Yeah.
Of course, now, Tom Lee at the beginning of the year, he did, and a lot of these guys did make changes throughout the year. But think about this. If you said, oh my gosh, there's no room here, we're not going to make that much money this year, I'm going to stay out of the market.
I'm just going to go lock in a CD.
Yeah, go in cash. You missed out on a 20% move. This just in. So...
And not that it was relevant because we had two 20% years up back to back in 2023 and 2024. But oftentimes the best days as far as returns happen right after the worst ones.
Yeah. And if you miss out, we showed the chart before. If you miss out on the best 30 days, it's a significant difference.
Yeah. If you're sitting on the sidelines, you miss the rebound.
Yeah. So let me go and show you what the analyst expectations are
for this year.
And let me just, first of all, before I do that, I do want to check one thing. I want to see exactly the S&P closed at today was, I think, 63.45. So that will help me. 63.45 on the S&P 500. So let's go ahead and share that slide. So these are the firms and the estimates for this year. So we did the format a little bit. By the way, these slides are provided to us by First Trust, partner of ours. We like them a lot. They have really, really tremendous research.
They're fantastic.
And I'll point out, though, they think the market would be down this year. They were down 11.6%. And they have these earnings models and Brian Westbury, who's tremendous, and they've been renowned as one of the top research firms in the country.
And typically a permable. He was, made fun of.
Now he's changed his tune since then. So so anyway, again, here we go. So now everybody aside from First Trust has a bullish posture. So the average return for 2025 was 11.3%. But you go all the way up to now. Today we close at 63. What did I say? 63.45. So Oppenheimer was at 7,100, and Wells, and all the way down to First Trust 5,200. So we are right here around that UBS BNP. So if you listen to the analysts, the market's up 7.8%, I think, year to date. Call it 8%. And so we have another 300 basis points or 3% to go if the analysts are right. But here's the thing. Those medium numbers are never right.
No.
They're not. So...
And this just goes to show that you can't let what analysts, no matter how many letters they have next to their name or whatever PhD that they have or whatever the case may be, dictate what you as an investor choose to do moving forward. You need to have a plan in place that is what dictates how you proceed.
And I think this next slide really hits home as to why you want to stay in the market. And we're going to talk about other things too. It's not about just all permable in the market 100% all the time. But this is just an example. This one right here. $10,000 in the S&P 500 back in 1980 to just recently, 2024. You put 10,000, never left the S&P. You stayed in the entire time. You made 1.5 million in that time frame. Where that 10,000 is now worth 1.5 million. If you miss, just by missing the best 5 days of 44 years, best 5 days, you're at 936,000. The best 10 days, 674. If you miss the best month of the market, you're at 242, which is a lot of money from 10,000.
Right, but it's a hell of a lot less than 1.5 million.
So, yes. So the point is here, folks, is that you want to really come up with a plan And if you don't have an advisor that can give you that plan, find one. All right. If it's not us, that's fine. Find someone else, but you're not going to find anybody as good as us. That's number one. So here's what we're doing for our clients. We're saying, listen, I think that the market is a little bit ahead of its skis right now. I do. I think that we're going to, and not long term. I'm thinking now in the short term. I believe that there is certainly, because August and September are usually horrendous for the market, usually not really good. Seasonality is going to be not strong here, but you have to be able to still pivot. And if the market participates, let's say we're wrong, and there has been decent August, Septembers.
Yeah.
Not a lot of them, but there has been. What if we're wrong and there is one? So you still have to be invested, but there is that part of that portfolio. And what we try to do, Nikki, in our portfolios, we protect using our buffered strategy, or RMS, which is a risk mitigation strategy, which if the market goes down significantly, we have some protection there.
Yeah. You buffer or suffer.
Exactly. Oh, that's great. I love that. Buffer or suffer. But then we want to keep part of the portfolio in a tactical mode, right? So let's say we say, okay, 80% of our strategy, Joe client, we're gonna put in a 70-30 portfolio that'll create about 3-4% in dividends, because that's huge. You want to get those dividends, especially if the market's not doing well, and it's going to be buffered. But we're gonna of that 70-30, we're gonna leave of your entire. Let's say you have of $100,000, we're gonna put 80 or 85 or 90, and this is part of that. We discuss what's your comfort level. What do you want tactical? And they will say, okay, well, we're okay with 20% tactical. So 80% will have that strategy, and the 20% we may be in, we may be out, we may do different things, we may do sectors, we may say we want to own this AI stock. There's a lot of different strategies within that strategy.
Exactly. I mean, you want to make sure that your plan is tailored to your unique needs, whether that's income at this point in time, whether that's income down the road, your risk tolerance, as well as your risk capacity, the goals that this bucket of funds is designed to achieve. And then based off of that, what we do is we go in there and we customize it to what you specified and shared with us. And then we also get to, within that tactical sleeve, get to play a little bit, if you will, as far as what we think because even though we think that the market, broadly speaking, is over its skis at this point in time, we are still finding opportunities that we've talked about. I mean, we picked up some Palo Alto Network, not that long ago after their acquisition. We are finding opportunities, and that's what we do. We love to do that all day long. And so, we're still able to carve out that opportunity within portfolios where it's appropriate for somebody's risk tolerance and capacity to do that.
Yeah, and we'd rather do that than have people, look, I love NVIDIA, love the stock, but I don't want you to buy it here at 180 a share.
I love it, but I will really quickly come to hate it if I see people start buying it here.
Right, and here's why, folks, is we tell people, and it's just experience and knowing how to read technicals of the charting patterns, which I'm an expert in. Thank you.
Yes, you are.
The stock's extended. It's going to come back and meet that red line, which is a 50-day moving average at some point. It has a history of doing so. Here's the red line. It rallies up, pulls back. Rallies up, pulls back. Rallies up, pulls back. Rallies up, pulls back. Rallies up. And then comes back below, gets up, gets way below. This is then that March, April time frame. Gets back above, and it has stayed there. So it has stayed above the 50-day moving average quite a long time. That, to me, is a little bit scary. One of the big movers, this was AppLovin, which is a high-flying company that, and by the way, I'm sorry, this is NVIDIA. We do own NVIDIA, too. I believe you do, too.
I do.
AppLovin, I think I own AppLovin.
I do not. Okay,
I believe I own this one. But this one was a high flyer, and it got way above its skis here, right? And above here's a 50-day, and it finally got back and met it. People thought at 417 is the greatest company in the world, and within 2 months, it's at 307. That's a whack. That's a 25% whack. And then it rallied back up to 525.
And if you got out at 307... after you were like, I should have got out at 417, and then you saw it go down to 307, you're like, you know what, I got to throw the towel in. How silly did you feel when it came and ripped back up to 525?
Yeah, because it pulled back to support is what it did. It got way ahead of itself. It went from
without a doubt
82 back in September last year to 417 in December.
But I just the point I'm trying to make is like everybody's rear view mirror is as good as the rest of us. And this is what I think these euphoric swings lead to people selling out at all the wrong times.
Yeah, I mean, Broadcom, it's extended.
Mm-hmm.
Let's take a look at Tesla, because Tesla was showing me something today interesting.
Yeah.
Tesla's forming a pattern. Now, it hasn't done great.
Cybertruck.
It's
literally.
the Cybertruck. This Cyber. Oh, yeah, look at that. It is.
Who knew? I found a new chart pattern. A new name.
That is a Cybertruck pattern
There
for
you go.
Tesla. There you go. That's great. That's smart. So Tesla's, look, they had the quarter was not good. And however, the stock is trading in this it's getting really a little tighter range. And I call this a symmetrical triangle, and where
the Cybertruck.
the Cybertruck triangle, and it just trades a wide range and starts tightening up. So the next volume's going to win here. And the way it acted today, up 11 at 3.5%, it looks like it wants to break through that. And if that happens, that's a pretty accurate chart pattern. So I own Tesla as well.
I do as well.
But it's funny. I often say I own enough Tesla I can buy a few of those. So, but Tesla is a right now questionable, but it looks to me it's getting me a little closer to a bullish posture.
Okay.
It's not a recommendation right now. I'm not saying to go out and buy it, but at some point, I think if it breaks through the top side of this symmetrical triangle on a technical basis, because fundamentals, we know what Tesla does, and we know that it's a $1 trillion company now. And it is. What's interesting
it's
is
$1 trillion tech company.
I want to just explain. It's not an auto manufacturer,
No.
because Tesla is their company valuation is $1 trillion, right? Let's take a look at
the
what
amount of
Ford.
cars that they deliver.
Ford is $45 billion.
And they sell like an F-150 every minute.
Yeah,
in the United States.
GM is $50 billion. So those are car manufacturers. So Tesla is being valued as a major tech company with AI capabilities and everything else thrown in there. But interesting. So, a lot of these, Palantir, another one of those high flyers.
Yeah.
I own that one too. We have
I do
clients
as well.
and everything. Clients own the stuff I own too. But this is extremely extended. I mean, look at this.
Yes.
The 50-day moving average is at 140 and the stock's at 179. So, but it did pull back in June to 128 to the 50-day. That was your opportunity right there.
And I will say that is when I took the opportunity.
Okay, so you bought it here,
And I bought it for some clients there as well.
During the bad correction in March, April, it got down to 68. That's a 200-day. We bought a bunch in this area, but it's one of those. It's a semiconductor company that's really in software that's involved in the defense industry. So, I mean, these are some really incredibly great companies. There's some great companies out there, but you have to own them at the appropriate times.
Exactly. There is no shortage of innovation and brilliance and wonderful ideas out there in the marketplace of ideas, and also within the best and biggest companies in the United States.
So
it's just about when are you, what entry point are you going to get on the ride with that company that you believe in, and make sure you can explain what they do, you believe in what they do, and that their balance sheets, the fundamentals are strong.
Sure, and that's what you got to look for. I mean, the moral of the story is you want to be invested, but you want to be invested in a right way. You don't want to go out and chase things. That's
Right.
do not chase these high flying stocks. You will get hurt more times than not. You may get lucky every once in a while. You're gonna pick some of these, and look, Meta has been one of those. I mean, you may get lucky, but Meta has been one. I've made money on Meta over and over. This has been always a rental for me. I've never owned it for the long term. I'm in it right now, and I'm up
I am as well.
several $100s, but it's extended now. So it wasn't extended. Look at this, though. It wasn't extended a week ago. You had a chance to buy that at 700. Now here it is, 70. So there are times you just got to trust yourself. Find an advisor that knows what they're doing. Find an advisor that can maybe talk you through these things. But there's always opportunity. And again, the stock market, it's not, and most of our clients are not full bore stock market, because most people are getting approaching retire. A lot of them are approaching retirement or in retirement, and they don't want to be full-time stock market. That's where the fixed income comes in.
And we've touched on this. I mean, I'm 32 years old. I have short-term goals that I want to achieve within the next 1 to 2 years. And so that bucket of money for me is not full-bore stock market risk.
Not in the stock market.
That is within our RMS strategy, because I don't want to 2 years from now, when I'm ready to, make that happen, I don't want that. Oh, now I've got sequence of return risk because the market's down and, everything's in the shitter.
RMS, again, risk mitigation strategy, something we employ in, I would
Broadly?
say, I don't want to say 100%, but I want to say 90% has implementation of the risk mitigation strategy, only because
it makes sense.
When the market goes down 20, 30%, because it will again, I promise you.
That's the one thing in our business where we cannot guarantee you anything. The only thing I can promise you is volatility.
Yep. And it'll happen again. And
that's why we have something in place, bear market protection. Yep. We have different layering versions, different varieties of downside protection, depending on the time horizon, the risk tolerance, et cetera, that we've touched on. We have plans put into place for each of our clients that are completely tailored to them. If something changes within their lives, that's when the plan needs to be adjusted and reevaluated, not because of headlines, not because of market cycles, not because of elections. None of that matters.
Tune out the noise.
None of that should dictate your investment strategy. Focus on the things you can control, the amount that you're saving, the amount you're putting away for your investments, what you're putting away for your retirement, your asset allocation, your investment strategy. That's what you can control.
Again, those retirement plans, maximum. You know what?
Yes.
We could go on all night, but I want you to give us a call. Let's talk about your retirement plans. Let's talk about this stuff.
2026 is coming up, guys.
Yeah, let's plan for that. So listen, I really appreciate everybody listening tonight and watching. If you have any questions, give us a call. This is Nikki Ward, our Megalenial.
This is Lee Seiler, the Stock Doctor.
Actually, there was a delay on the button.
Yeah.
I meant to hit the applause button for you, actually. So, okay, this is Nikki Ward. See, there's a delay. All right. You guys have been awesome. Thank you so much. We appreciate you, and we'll see you soon.